Are you concerned about the risks and dangers that you take when you go to sell your home in the city of Toronto? Do you have questions about what happens if a buyer fails to close the transaction? In this video, I'm going to get into the things that you can do to best protect yourself from a failed closing. Please comment below. I'd love to get your thoughts on if you've experienced a failed real estate transaction, or maybe you know somebody, and I'd like to know what was the outcome. Part of your retirement strategy might be planning a move. Maybe you're going to move outside the city. Maybe you're going to move to another province or even another country. And when you're starting to plan the sale of your home, you're normally going to want to bring in a realtor to assess the home, determine what the market value is, what the current market conditions are, and what's the best strategy to market your home. Let's discuss some of the key elements in order to protect yourself from any dangers and risks when selling your home. And at the end of this video, I'm going to have some bonus information for you on actual case law of what some of the outcomes were from other property owners and what they faced when their properties failed to close. Once you receive an offer on your home, one of the key points in order for you to protect yourself from any risk or danger from a property failing to close is going to be to qualify the buyer. You might ask yourself, well, how do I qualify the buyer, or whose responsibility is it to qualify the buyer? Well, first of all, if you're working in organized real estate and you're going to hire a professional realtor with experience as a listing agent, part of their duties and responsibilities to you will be to qualify the buyer, and they'll help you navigate this by asking very specific and pointed questions to the buyer's representative. And, I have a lot of experience in this area, and I like to start by qualifying buyers through their agent by asking, what is the buyer's financial capabilities? Outside of being pre-approved for a mortgage, which that means basically the buyer has been to a bank or they've talked to some sort of lender, they've given some basic information, and they've been given probably just a verbal pre-approval, here's the parameters for what you can purchase. But they haven't yet received a mortgage commitment. And a mortgage commitment is not given until there is a firm deal on a house. So the starting point is just to find out, what is that buyer's financial capability? Do they already own a property? What type of mortgage are they looking to take on? How much down payment they have, which is different than deposit. Deposit is going to be the money that they provide with the offer, but the down payment is going to be, are they putting 20% of the value of the home down? Are they putting 10% of the value of the home? And is there going to be a high ratio mortgage? And does the mortgage have to be insured? And then you have to start questioning the appraisal process. And that's something that a lot of sellers don't necessarily consider when selling their home, is what is the appraisal process and how is that going to impact their sale? When it comes to the appraisal process, us as realtors are really not involved directly with the lenders in terms of the facilitation of it. So another question I like to ask of the buyer agent is if they have a relationship with either a mortgage broker or the lender that's providing the financing to their buyer client. And more importantly, when do they plan on booking that appraisal? These last couple of years, we've been in these really overheated markets with very aggressive offers that are unconditional, and buyers are making offers, not subject to financing. And there's always been the question of how that home appraises versus what's the actual purchase price agreed to on the property. And a lot of people take for granted that they're automatically just going to get pre-approved on the financing, but they don't actually have that mortgage commitment, which is issued once the deal is firm. So in today's market, where we are starting to see more conditions, which is better really for both sides, this is going to allow the buyer's lender to come through the home. And I always suggest you want that appraisal to be done during that, say it's 3 to 5 business days is a typical timeline for a financial condition to be satisfied. You want that appraisal being done in that window of time. This way, the underwriters have been given the report from the appraiser. Now that they can formally approve the mortgage and the mortgage commitment can be delivered to that buyer, knowing that finances are secure, so that should mitigate any risk of a sale not completing. And you as a seller, that will give you comfort and insurance to know that everybody involved in the transaction has done their proper due diligence. Some lenders or even agents maybe weren't arranging their appraisers until further on down the process. So as an example, even if your mortgage condition was in an offer or not, the offers get accepted, the paperwork gets processed. Maybe the lenders didn't send out an appraiser for another 30, even 60 days, depending on the closing timeline. And maybe the appraiser was going to come out just a couple weeks prior to closing on the agreement you agreed to. That's something that you really should never allow to happen. And I know there were times, both in 2021 and earlier in 2022, where the appraisers were so busy because of the volume of transactions that they were delaying the appraisals. But now with the market coming down and it's a moving target almost week by week and property to property, that can impact the appraised value of your home, how a lender is going to see your home, and depending on the type of mortgage product that buyer has qualified for is going to determine how much mortgage they can get. And of course, if they find out after the fact that now the mortgage that they require they no longer can get, well, that leaves them in a vulnerable position as well as you, because maybe this house sale for you, you're downsizing in retirement. You may be looking at the equity you're taking from the home. Part of it is to potentially fund your retirement, or maybe all of it is going to fund your retirement. And either you're going to go rent somewhere else or you're going to buy something that's less expensive. At this point in any transaction, you can always look back and ask yourself or your realtor, how did we qualify this buyer? Besides the pre-approved letter that they may or may not have had from their financial institution, whether they provided one or not, did you do your due diligence? Did you ask, do they currently own a home? How much is the mortgage on their current property that they have? So you can start to establish what's their financial capabilities. What's their plan B if things don't work out? What happens if they had to still sell their house and it doesn't sell? Do they have family that can loan them money in the short term to cover any shortfalls in case the property doesn't appraise the way that you might think? And you'll know that with your realtor. When you see an offer come across the table, you'll have a good sense of whether or not your home should appraise at that price. Obviously, with the downturn in the market and things are changing on a weekly basis, it's happening pretty quick. And again, that's why you want to make sure that the appraisers come out as fast as possible once you have an accepted offer, so that that part of it is now not part of the equation in terms of your house's ability to close and move on in your life. So again, I think you always have to ask, what is that buyer's plan B? And you and your agent need to be able to sit down. And there's ways your agent will have the resources and databases to be able to look back up who the buyer of your property is, where they live. They can look up if there's a mortgage on the property. How much is the mortgage for? You can start to establish pretty simply with a little bit of due diligence on your end whether or not your buyer is actually qualified to buy your house. And this is another way to protect yourself from dangers and risks when selling your house when you're either retired or preparing to retire. Another part in the appraisal process that I'd like to touch on is what's known as the bank's appraised value. And I think the term bank, or the word bank, is a really key word to understand. And I can give you an example of, I have clients that were doing some refinancing, coordinating a home line of, like a home equity loan, personal line of credit that was going to be secured against the home. And of course, an appraiser from the lender had to come out to the home to determine the market value of the home, and so that they could determine how much line of credit this family could have. I'm not going to name the bank, But obviously, and it didn't matter for the refinance purposes, how the home appraised, but it was an interesting exercise in how the bank views your home and how they determine lending money. And what they had done is, the appraised value came back, and in our conversation with the representative of the bank, there was a huge discrepancy in what fair market value on the house was going to be, and it was to the tune of about $300,000 or $400,000, so not insignificant. Again, it was just for a line of credit, so it wasn't impacting a buyer's ability to purchase a home, but just more how the bank views your home from an appraisal perspective. And the conversation I had with the lender, because I had went back to him and, given him some comparable sales and asked, can you share this appraisal report? And the answer was just a flat out no. It's for the bank, it's for their file, and it's called the bank's appraised value. So I think the appraisal came in, probably legitimate appraisal. The bank knocked out some of the value to reduce it to protect themselves, I suppose. But the point being is the line from the bank that I got was, the bank's appraised value is best for the bank's shareholders, but not customers. So you just have to understand when the appraisals come in, they're generally not going to be right on par with what the agreed purchase price is on your home, but it should be within a range so that it doesn't impact that buyer's ability to borrow money. Example, if it's an 80% loan to value ratio, that means that, if they were taking $1 million, let's say it's $1 million house, the bank is probably going to appraise it or give them a loan for up to $800,000. And so that home has to then appraise at that price minimum, or the buyer is going to have to bring more down payment to the money or to the table, to close the deal so that their mortgage is within that 80% loan to value ratio. And that's why it's important during the qualifying process to ask about that buyer's financial capability and their plan B and where they're going to have other money come from in the event that the house doesn't appraise where they need it to appraise. Another question, a very important one that you are going to want to ask is, what happens if the buyer of my property fails to close? It becomes a very stressful time for you as a homeowner because you've made all of your plans and you've made your plans surrounding the sale of your property. But really the first thing you have to do once you receive word from your lawyer that the deal's not going to close is you're going to have to ask your lawyer a few questions in terms of them negotiating or talking to the buyer's lawyer. And likely you're going to have to grant an extension of some kind, which is going to further provide that opportunity to the buyer to be able to secure other forms of financing, whether they have to borrow it, whether it's family that's loaning them the money, or maybe it's a private lender. It gives them a little bit of time to be able to do that. So you have to try and mitigate the losses, and you have to be reasonable. So in this kind of scenario, you're generally going to grant an extension. The second piece of that extension might be you may want to ask for a further deposit. So depending on the feel you get from that buyer, if they're determined that, yes, we're still going to close, we just have to secure other forms of financing, we're confident we're going to get it sold, we just need a little bit more time, great, no problem. Okay, to do the right thing, you're granting them that extension, but you want some more security. So that might be a time where you're going to ask for a further deposit. And you may want that deposit to be non-refundable, non-negotiable. And you'll also want that held in your lawyer's trust account. And that's another important piece about holding deposit monies. Oftentimes, the deposit money's held in the real estate broker's trust account, which is fine. But sometimes in cases like this, or if you're talking really large deposits, you may want part of it in your real estate agent's trust account. You're going to want part of it in your real estate lawyer's trust account because real estate lawyer's trust accounts are governed a little bit differently than a real estate broker's trust account. And so for more information on that, my contact information's in the description below. I can give you a list of lawyers for you to be able to ask those very important questions to when it comes to getting further deposits and how deposit money can be held in a real estate lawyer's trust account. You may be at the point where you've exhausted all reasonable measures to grant your buyer that opportunity to close the transaction. You've granted an extension to secure financing. That hasn't worked. Maybe you're even in the kind of position where you could consider a vendor take back mortgage where you hold the mortgage for a period of time. Maybe it's 6 months, or maybe it's not feasible for you and you're not going to go down that path. But basically, you've done everything you can to mitigate loss and damage to this buyer. And at some point you're going to just move on and sell the property. And, at this time, you're just moving on, you're selling the property. The first request that's going to come from the buyer's agent or the buyer's lawyer is going to be for you to sign a mutual release. And oftentimes people take for granted, agents included, oftentimes agents and consumers take for granted that a mutual release should just be signed, you move on. Maybe that buyer's just going to forfeit the deposit because a lot of buyers think, oh, okay, I'll lose my deposit, no harm, no foul. It's too bad for them, but they're able to just move on in their life. And once you sign that mutual release, what it means is you're giving up your right to then go after that buyer to sue them financially, say if you subsequently sell your house for less money. So it's really critical that you consult not only your real estate lawyer before granting a mutual release, but a litigation lawyer, which is even more important because they need to look at your situation on a case by case, and they can give you better advice on what's best for you and what you should do to handle your transaction. You can still subsequently go and sell your house without the mutual release. So don't let anybody tell you that you can't do that. But what's not going to happen is those deposit funds are not being released. And that's where it makes that key distinction and why you must consult a real estate lawyer about their trust account and a real estate broker's trust account, because the only way that funds can be released from the real estate broker's trust account is by way of mutual release, court order, or the lawyer's instructions upon completion that the transaction is closed. Then the funds can be released. So if there is going to be a dispute, those funds are going to stay there. And that's why it's critical that you have some money in either of both your representative's trust account to best protect you and what your options are going forward. So now we're going to get into the bonus coverage I wanted to share with you. And I want to talk about case law. And Canly is an incredible Canadian legal database that shares case law and specifically with failed closings in real property. And it was from a closing from back in 2018. So the one thing is if you have a failed closing, you could expect it could take a few years to go through the entire process. But in this case, it was a failed closing from October of 2018. The purchaser had paid or agreed to pay $1.5 million for their home. It was to close. They failed to close due to not being able to get mortgage financing. They thought they were just going to, say sorry, shake the builder's hand, get their mutual release, and forfeit the deposit. Well, that wasn't the case. The seller didn't sign the mutual release, clearly seeked out counsel, talked to a litigation lawyer. It was then determined that they were going to sue that buyer for damages. And in just this year, in June of 2022, that seller was awarded $580,000. So what had happened was when he relisted the property, it was subsequently sold for about 2/3, so about $1,012,000. And then between the deposit money and the damages that the seller incurred, the judge awarded that seller $580,000. So again, just another indication why you never just sign a mutual release. And no agent should ever just be telling you to sign a mutual release and move on. That's a conversation for you and your real estate lawyer, and more specifically in this kind of case, a litigation lawyer. So again, if you ever have any questions about that, or if you need any information on litigation lawyers, my contact information again is down below. So see it in the description. You can shoot me an email, phone call or text even. Very easy to reach, and I'm happy to share any resources I have with you. I do hope that you did find value in today's content, and you do consider subscribing to my channel, and I'll see you on the next video.